Hello, everybody. This is Anil Sangi. I'm an MBA Finance from Narsi Monji and a CFA from US. I have work experience of more than 15 years leading teams in the fields of finance, accounts, and financial planning and analysis. I have worked for companies like HSBC, Infosys, Capital One, and HP Enterprises. All along, I have been a teacher and I have been teaching accounts and various management subjects to students. This video series is an attempt to lay a strong foundation of accountancy for class 11 students. This gives them the flexibility to learn the subject at their own space and also gives them the opportunity to relearn the subject, to revise the subject as and when they want it. They can listen to this series as many times as they want in an attempt to master the subject. So let us start the series. So let's start. In today's video, we are going to look at chapter number 1, which is Introduction to Accounting. In this chapter, we'll learn what is the meaning of accounting. I'm sure all of you have started with this new subject called accounts and you are excited to take this subject and you want to understand what is accounts or accounting all about, how it is going to help me in my career, what is that I'm going to learn in this subject, and what is the relationship of accounts with other subjects in my stream, that is economics, maybe statistics and other things. So let's start and go through this chapter. So the first thing that we'll look at is what is the meaning of accounting. Then we'll look at process of accounting. So when we say process, it means there is a step by step approach to doing something. So even in accounting, we have a process to do certain things. We'll look at what is the process, and then at last we'll look at what is the definition. So the reason that we have to keep the definition at the end is once you've understood what accounting is all about and what is the process of it, definition is going to be very easy. So let's move on. So meaning of accounting. Accounting helps stakeholders to understand financial performance of a business or an organization. So the main terms in this meaning are: what is a business organization? What is financial performance? Who are my stakeholders? Or what does stakeholder mean? And why do they need accounting information? We will look at each and every aspect of this definition as we go along, and you will understand very clearly what does this mean. But please remember that the purpose of accounting is to help stakeholders to understand financial performance of a business or an organization. So the first question, what is a business organization? A business organization is an entity which is involved in production, purchase, and selling of goods and services with a profit motive. So there are firms which are involved in production of certain things. Then there are firms which are into trade. They buy and then they sell certain things. And these can be goods or these can be services. Goods mean something that we can touch and feel. Say for example, a automobile. And services are something which we can feel but we cannot touch. For example, somebody providing the service of being a lawyer, somebody providing the service of a chartered accountant. So there are services which we cannot touch but we know that they are important. A teacher is providing you a service. You cannot get the product of knowledge, you cannot touch and feel knowledge, but you know that knowledge is a very important thing, right? So what kind of products and services do these business organizations provide? They can provide all kinds of services from simple grocery stores to complex machinery like aircrafts. So on a day-to-day basis, we take services and products from various vendors. So to begin our day, we buy milk. Then we have to buy groceries. Our parents go to supermarket and then they buy groceries. When we go to college, we need to use some kind of transportation, maybe it is our own car or maybe a school bus. So all these are examples of products. There is somebody who's producing this goods or services, and then they are selling these goods and services to us. Let's look at some of the examples. So farmers are business organization. They are producing crops for us and then they are selling it to us. And they are intermediaries through whom we buy rice, wheat. So many things farmers are producing for us. Then you have dairy farms which are producing milk, cheese, butter, and then these are being sold to us through kirana stores or supermarkets. When we go to school, college, or training institutes, these are the firms which are providing some kind of service to us. We buy cosmetics, we go to saloons to cut our hair, we go to cinema halls to watch movies. Then, as we go along, you see a lot of IT companies, automobile companies, airlines, banks, CA firms, law firms. So, we use hundreds and hundreds of products and services on a day to day basis. All these services are being provided by business organizations. A simple person who has a small kirana store is a business organization who's providing a particular product or a set of products to us, right? So I hope you are clear with this concept of a business organization. The ownership of the firm can have various structure. We'll learn about that in due course. However, the main thing about a business organization is that it is producing or purchasing and selling of either goods or services, and what is the end objective is to earn a profit. Second thing that we spoke about is financial performance. So what is financial performance? Financial performance measures the overall financial health of the organization over a given period of time, and in general this is 1 year. However, one can measure the performance even for shorter duration like quarterly, half yearly, or any other period that they would like to. And how do we measure the financial performance? There are a few parameters which gives us how is the financial health of an organization. The parameters are, first is the profit or loss. So first we need to understand, is the firm generating profits? Because as we said, the objective of an organization is to generate profit. So is it able to meet its objective? And in accounts, we have a statement called profit and loss statement, which gives us the output of the firm's performance in the current year. Second thing is cash generation. And in accounts, we have a statement called cash flow statements. So when an organization is new, it may not actually generate profit, but at least is the firm generating enough cash to continue the business. For example, Amazon didn't generate a profit for several years when it started the business because it was investing more and more into the business. Today, Flipkart doesn't even generate a profit. Still, it is a good business and it is valued at a very high price. The reason is that they are investing a lot into the business. So when profit and loss statement is not sufficient, we also need to look at another statement called cash flow statement, which gives us how is the cash position of the organization. Then the third is the financial position, which is depicted through the balance sheet. A balance sheet is a summary of the assets of the organization and the liabilities of the organization, and it helps us to understand whether the firm has sufficient assets to continue in the business and are the liabilities in sync with the assets, and how are the assets being used in a meaningful way to produce the products or the services that the firm is providing. Then we said accounts help stakeholders understand the financial performance, right? So what do we mean by stakeholders? And who are our stakeholders? Stakeholders are the people who are interested to understand or who are interested in our business, and they have an objective to take certain decisions from the output that the business is generating. So let's look at who are the stakeholders and what is their objective in knowing the financial performance. So we can broadly categorize stakeholders into two. One is internal, and in internal stakeholders, we have the owners. Owners are the people who have started the business, and then we can say employees, say the CEO, CFO, finance teams, marketing teams. Then there are business managers, product managers. To run a big organization, we need several hundreds and hundreds of employees who are working with different departments, but who have the same objective to ensure that the firm is able to produce products or services which help consumers, and in turn the firm earns profit. So they need to know how is the performance of the organization. CEO, CFO, marketing heads need to know the entire performance of the entire organization. But then there can be different managers who are responsible for certain geographies or for certain products. They would like to know how is the performance of the organization in those particular geographies or with respect to those products. And even a common employee would like to know how is the organization doing. Does the organization provide him or her opportunities to grow, to have a good career, whether the firm will be in a position to pay salaries, and whether it will be able to provide them job security? So when you read news, in the past we have seen organizations like Kingfisher, which went out of the business and they were not able to pay salaries for a few months. So even employees, a common employee who may not be a CEO or CFO, would like to know how is the organization doing, and they would like to know the performance over a period of time. Then in terms of external stakeholders, we have shareholders who are present shareholders or who may be interested to invest in the business. Then we have creditors. Creditors are the ones who provide certain loans to the organization. And in this category, we have banks, because banks provides loans to businesses to expand and run the businesses. Then we have debenture holders. Debenture holders are the ones who provide loans by taking a paper called debenture. And then there can be other kind of lenders, bond holders, etc., who are providing. Even a vendor who is providing us goods on a credit term is a lender to the organization. In certain cases, an employee, till the time his salary is paid, can be considered to be a lender or a creditor. Then customers would like to know about our performance, and competitors would also like to know about our performance. You might be thinking, why should a customer know whether I'm able to do my business well? How does it matter to them? See, lot of businesses, customers give you orders and you're going to execute it maybe over a period of 3 months, 6 months, 1 year. So they should know, one, do you have the technological know-how to produce the goods or services, say an airline. So maybe, today we have Air India, which gives Boeing an order to deliver 737 planes. So Air India would like to know, one, whether Boeing has the product to deliver that kind of aircraft, and second thing, is it financially sound, so that it will be able to give that product to Air India over a period of time, right? So even customers would like to know, and competitors would like to know about us, because they want to benchmark against us and they would like to see how we are doing, and they could also learn something from us. Then there are labor unions. We spoke about employees. Labor unions are also part of it, which would like to understand how different organizations are doing and how is their performance. Then government would also like to know. There are various governmental organizations which would like to know about the performance. Uh, Tax authorities are there who are interested to see how is your performance, because based on your performance they get income tax or goods and services tax. Then there are regulatory agencies like SEBI, a registrar of companies, RBI, and different regulatory agencies which would like to know your performance and how are you doing not only in terms of profit and loss, but also in terms of various products. Are you being fair to your customers? Are you being fair to your competitors? Are you doing the right things for the industry? Right? And then there can be many, many other people, say even a potential employee who would like to go for an interview, would like to know how the organization is doing. So there are many people who are interested to know, and all these people together as a set are called stakeholders. And again, just to repeat, there are two kind of stakeholders. One is internal, who are with the organization, and then there are external, which are not with the organization but are interested in our performance. So let's look at why stakeholders need accounting information. First of all, we said owners are stakeholders. They would like to understand which business or products are profitable. As an organization produces hundreds and hundreds of products, sometimes they would want to understand which product is profitable, in which geography is it profitable. And sometimes owners have multiple businesses, they want to understand which business is profitable. Then they would like to understand who are the competitors and how is their performance. And they would also like to understand how is our performance in various geographies, and which are the new geographies can we enter. So the reports which are being generated by accounting helps us to understand all this information, and owners are very much interested to understand the performance of their own organization and also of their competitors. Then we spoke about employees. Employees would like to understand the performance. Managers want to understand products of the performance of their departments or their products. Also, they should understand how is the performance of the industry so that they can benchmark against the industry. And employees to understand how the organization is performing and to know whether their jobs are stable and do they have enough growth opportunities in the organization. Then lenders would like to understand whether the firm is in a position to make periodic interest payments on the loans that they have availed, and can they return principal amount. They also would like to get financial statements to decide how much to lend for what period and what rate of interest should they charge for the amount that is being lent. Then investors want to understand how is the performance of the money that they have already invested in the organization, and which companies or which industry or which products are doing well, so that they can invest in those products. For example, today we hear a lot about artificial intelligence, we hear a lot about data analytics. So these are the upcoming industries, and investors would like to invest in those industries. About 20 years ago, IT was the flavor of the season, and even today, IT firms are generating very good profits for investors, right? So they should understand which firm or which industry is giving better profits, and they would like to invest in those industries or firms. And based on the performance of various organizations or industries, they decide how much to invest and at what price can they invest in those organizations. Then at last, we spoke about government and regulatory bodies. They would like to know the performance to say how much to tax various organization in terms of income tax, in terms of GST and other taxes. Are these firms following fair practices, or they are into unfair practices, and also to avoid monopolies? Then they also want to understand the financial performance to protect the industry and the consumer interests. Now we have covered what is accounting. We have understood the meaning of accounting, and we have also understood what is the meaning of various terms like business organization, financial performance, who are stakeholders, and why do they need accounting information. So now let us move to the next topic, which is about process of accounting. So the first step in process of accounting is identification. Second is measurement. Third is recording. Fourth is classifying. Fifth is summarizing. Sixth is analysis and interpretation. And last step is communication. We will look at each and every step. What does it mean and how we do this step in the next few moments. The first step is identification and the second is measurement. What does identification mean? Accounting is related to business transactions. So when there are transactions happening, we need to identify them. Which are the transactions which are related to business and which are not related to business. And these transactions have to be financial in nature. So in order to understand in more great detail what is a business transaction, please refer to my video on understanding this, which is for chapter 3. So what are the examples of a business transaction? When we buy a machinery, it's a business transaction. Buying of raw material, selling of finished products, raising of capital or a loan, paying of rent and salaries. All these are examples of business transactions. In your next few chapters, you will do all these things and you will learn about these things in great detail. But at this point in time, understand identification means identifying business transactions. The next step is measurement. So once we have identified business transactions, we need to quantify those business transactions in terms of money because accounting is only related to money. Something which cannot be measured in terms of money cannot be recorded in accounts. So we said the first thing that we identified is we bought a machinery. So we need to know what is the price or the amount at which we bought this machinery. When we do a sales, we need to know for how much amount did we do the sales. So buying a machinery for rupees 10,000 is quantifying it in terms of money. Doing sales for rupees 50,000 is again quantifying it in terms of money. And rent paid rupees 25,000 is also quantifying it. Now this unit of measurement can be rupees or dollars or any other currency. However, it is very important for us to quantify them in terms of money. And what cannot be measured in terms of money doesn't come under the purview of accounting. For example, an organization has a lot of teamwork. It is very important for an organization. However, we cannot measure teamwork in terms of money and hence it doesn't come under accounting. Quality of products are very essential for us to run a business organization. However, we cannot measure the quality of products in terms of money. However, the cost to produce a quality product can be measured in terms of money and that can be recorded. But whether the products are of high quality or low quality or acceptable or non-acceptable, that is not part of accounting. Similarly, quality of people that we have or the brand value or the brand name, these are some of the things which cannot be quantified in terms of money, except in certain cases when there is, you know, uh, when some firms sell its stake or there's a merger and acquisition, brand value and brand names and goodwill can be measured. But in many other cases, this is something which cannot be measured and hence they do not form part of accounting. Then the third step is recording. So what does recording mean? Recording means making a note in a systematic manner. And where do we make this note? We make it in the books of accounts and we also make this note in a chronological order. What does chronological order means? Based on the date that this transactions are appearing, we have to record them in a serial order. The transactions which have happened on an earlier date gets recorded first and then the transactions which happen later gets recorded later. The book in which we record this transaction is called a journal, and also we have other subsidiary books where we record transactions. You will learn this in the chapter which is related to journal and other subsidiary books. Then once you have done the recording, We need to classify these transactions. As I said, when you are recording, you are going to record the transactions in a chronological order, which doesn't really help you to understand those transactions, right? To take out any meaningful information from them. So to do that, we do a process, or we do a step called posting of these transactions into various accounts. The purpose of that is for easy identification and to put one kind of transaction in one place. For example, all sales are classified and then they are put into sales account. All transactions which are related to purchase are then posted into purchase account. All cash transactions are posted into cash account. All transactions which are related to paying of rent are put into rent account. Similarly, for each type of transactions, we make certain accounts and we post them into those accounts. And this is in a book called ledger. And this is called classification. Classification means classifying those account into ledgers and putting them in accounts, right? Then the next step is summarizing. So summarizing means to summarize the results of these accounts. So what is happening? How much sales did we have? How much rent did we pay at the end of the year? How much purchases did we do? Right? And the objective of this particular summarizing is to understand the accuracy, the understandability and presentability of the information. So we might have paid rent in different months, but we need to understand whether the amount that we have calculated in our books and the amount that has paid from the cash from the bank is matching. So we need to know whether we have done everything accurately or are there any errors. In case there are errors, we need to rectify them. Second thing is that management would like to understand this information, and this should be presentable in an easy way so that everybody can make sense out of it and make certain decisions. So which are the statements that we use for this? We have something called as a trial balance, which gives us a summary of all the accounts. Then we have profit and loss account, which basically tells us whether the firm is generating a profit or is it incurring losses. Then we have already spoken about cash flow statement and balance sheet. These are also statements which helps us to understand the financial performance of the organization. So we summarize all the accounts and we put them into some of these statements for easy understandability and for presentability. The next step is analyzing and interpretation. So what does analysis and interpretation mean? Basically, analysis means making sense of the performance to understand whether it is good, whether it is bad, which are the areas where we are doing well, which are the areas where we are not doing well, how we can improve upon certain areas, right? And interpretation is how to take decisions from those analysis that you have done. So, what is that we are trying to find out through this step? One thing is we are trying to find out, are we earning sufficient profit? This profit can be in terms of gross profit, operating profit, or net profit. How is the debt levels? Are they manageable? How are the liquidity levels? See, all these terms in my next video, I have explained various terms which are used in accounting. So please go through that video to understand if you don't know some of these terms. Then how is the position of receivables? Receivable is something that we need to receive, and payables are something that we need to pay in terms of money. How is our performance in this year versus our prior years or versus prior quarters? And how is our performance versus our competitors or industry? These are all very, very important things. There's a whole set of teams which are working in an organization which is doing just this one step. They are trying to understand the performance of the organization. They are trying to find out how the performance can be improved, which are the areas where we need improvement, and they're trying to benchmark it against the industry, against competitors. And there's a team which is called financial planning and analysis team, which is doing exactly this work in many organizations, and there are many more levels of it. But however, as you're just beginning this subject, it is enough for you to know that analysis and interpretation means making sense of the performance and interpreting the performance for decision making. And the last step is communication. So what do we need to communicate and to whom? We need to communicate the performance that we have seen in the last few steps to our stakeholders. And what do we communicate? We communicate how is our profitability, how is our cash flow, how is the balance sheet, then our interpretation of it, our analysis of the performance, and how does management views the business, how is the performance, how does the future look, are we in a position to do well in the next years, what are the risks, where are the opportunities for the business, and all these things are being audited for accuracy by chartered accountants. There are firms which are specializing in audit, and they have a very critical role to play. So all these statements are put into a report called an annual report, and which is shared with the shareholders, and it is available even for others to go through. Currently, most of these statements are available online on the website of the organization. Small firms may not produce everything, but definitely all the firms will try to produce a profit and loss account and a balance sheet. They may not produce other statements, but the very critical statements are profit and loss account and the balance sheet. Then we also have to find out how much income tax we need to pay, and we communicate that to the government, and then GST returns which are filed on a monthly and quarterly basis. So all this information from the financial performance is communicated to various stakeholders. So these are the 7 steps that we have spoken about. Let us revise them. First step is identification, and you can remember it as I. And what does it do? What do we identify? We identify business transaction. Then we measure in terms of money. Third step we do is record. What do we record? Business transactions. And where do we record it? In journal in a chronological order. Then we classify into ledger. We try to put all one type of transaction at one place. Then we summarize these transactions. The objective is to ensure that these are accurate, they are understandable, and they are presentable. We use statements like trial balance, profit and loss account, cash flow statement, and balance sheet for this purpose. Then the next step is analysis and interpretation. It means making sense of the performance, comparing that performance versus our prior quarters, versus our prior years, and comparing it against the competitors as well as the industry. And the last step is communication. We communicate this information to our stakeholders for them to take certain decisions. How is the performance of the organization? We communicate through profit and loss account, cash flow statement, and balance sheet. We also give them an audit report to show that the firm has done everything accurately and as per the standards. And then we also give to them management outlook regarding the current performance and the future performance. So I have made a small mnemonics for you so that you can remember the 7 steps very easily. And it goes like this: I must reduce cheese sandwich and ice cream. I know a lot of you may not agree with me, uh, but it is very easy to remember. So you can remember this: I must reduce cheese sandwich and ice cream. So each of the first letters I have put there, and I hope this will help you to remember all the 7 steps easily. So this is the accounting process as given in the text. So economic events, then we links to what is the accounting process, then we communicate that information to stakeholders, to internal and external users who make decisions, right? So this completes our first 2 topics, which is what is accounting and what is the process of accounting, we come to our last topic, which is definition of accounting. The reason I've kept it at the end is for you to understand the meaning, and then the definition becomes very easy. Accounting can be defined as the process of identifying, measuring, recording, and communicating required information related to the economic events of an organization to the interested users of such information. So let's look at what are the important terms here. First thing is economic events, that is what we have defined as business transactions. Process of identifying, measuring, recording, and communicating. We have already looked at the process, the 7 steps. Then we have said what is a business organization. And at last, we have said who are the interested users of information, that is our stakeholders. So I'm sure as you have learned it, it will become very easy for you to remember the definition of accounting. What my suggestion is, you can write the definition in your own words. You don't really need to, mug up it, or even if you want to put it in whatever form, just ensure that you highlight what are the important steps in accounting and what is the purpose of accounting, right? And second thing that my suggestion is, if you are giving this definition as per any of the international bodies or as per accounting, ICAI, in that case you need to be 100% accurate. You have to be verbatim as it is being defined by them. Otherwise you can give it in your own words and explain what is accounting all about, right? Yeah. So that brings us to the end of the current video, and let's look at the summary till now. So first thing that we looked at is what is meaning of accounting. We said accounting helps stakeholders to understand financial performance of a business or an organization, and we defined organization as an entity involved in production, purchase, and selling of goods and services with a profit motive. Then we looked at what is financial performance. It measures the overall financial health of an organization over a given period of time, which is generally 1 year. It can be less than that, maybe 3 months and 6 months, but usually it is 1 year. And the statements that we used here are profit and loss account statement, cash flow statement, and the balance sheet. And the last thing that we looked at is communicating this information to stakeholders. Stakeholders are the ones who are users interested in accounting information. These can be internal stakeholders or external stakeholders. Then we looked at what is the process of accounting. This is a 7 step process. First step is identification. Second step is measurement. Third step is recording. Fourth step is classifying. Fifth step is summarizing. Sixth step is analysis and interpretation. And the last step is communication. So the first letter of each word you can remember, that is I, M, R, C, S, AI, and C. So you can remember this by the mnemonics. I must reduce cheese, sandwich, and ice cream. And at last, we defined accounting as the process of identifying, measuring, recording, and communicating required information related to economic events of an organization to the interested users of such information. Thank you so much for joining us today. If you like this video, please uh, mark it and press the bell icon. In this series, we are going to record all the chapters for class 11, and I will be posting all the lectures. Please share with your friends and everybody else in your school, college. Let us create a culture of learning and let every child learn. So, with that request, we end this session. Thank you so much. Let us know your feedback. Let us know your queries if you have any. And in subsequent videos, we'll also do question and answers, we'll do illustration problems, we'll do problems which appear at the end of the chapter. Thank you so much. Have a good day. Jai Gurudev.